In this video, we're going to explore the best dividend stocks for 2025. Whether you're looking to grow your passive income or build a rock-solid portfolio, we've got you covered with top picks that promise strong yields and stability. And if you love dividend stocks, make sure to attend Seeking Alpha Dividend Investing Forum happening on March 5th. To sign up, just click the link in the description to get Seeking Alpha Premium for $30 off and 7 days free. At this forum, you will join top analysts and industry experts as they explore how to build sustainable portfolio income and answer key questions like, does yield matter? Dive into high-quality dividend stocks, REITs, bond ETFs, closed-end funds, and more. Coming in at number 6, we have Opera Limited, ticker OPRA. Opera provides web browsing, AI-driven content discovery, and fintech services. The company operates a range of browsers tailored for different devices, including desktop, mobile, and gaming. It has expanded into AI, cryptocurrency, and e-commerce solutions. Here's why I love this stock, and at the end I will give you one red flag to consider. First is high yield, happy wallet. Opera is currently offering a juicy dividend yield of around 4 to 6%, depending on the stock price, paid out semi-annually, way above the average for tech stocks. That's cash flow you can count on, making it a sweet deal for anyone looking to pad their portfolio with steady income in 2025. Second is AI-powered growth engine. With a big partnership with Alphabet to integrate the Gemini AI model into its browsers, Opera's betting on AI to boost user engagement and ad revenue. This forward-thinking move could drive earnings higher, supporting those hefty dividends for years to come. Third is undervalued gem, ready to shine. Trading at just 2 times sales and 11 times adjusted earnings before interest, taxes, depreciation, and amortization, Opera's stock looks dirt cheap compared to its peers, especially with its solid profitability and growing user base. That low valuation sets a strong floor, giving you both dividend income and upside potential in 2025. Now, before you smash that buy button, let's talk about the elephant in the room. The biggest red flag, which tiny market share, big competition. Opera holds less than 3% of the global browser market, dwarfed by giants like Google Chrome and Safari, which dominate with over 80% combined. If it can't carve out a bigger slice against these titans, growth could stall, putting pressure on those dividends down the road. Coming in at number 5, we have Altria Group, and the ticker is MO. Altria Group is an American tobacco and consumer goods company headquartered in Richmond, Virginia. It is one of the largest producers of cigarettes, smokeless tobacco, and nicotine products, best known for owning Philip Morris USA, the maker of Marlboro cigarettes. Altria also has investments in cannabis, alcohol, through Anheuser-Busch InBev, and vaping products. The company focuses on transitioning to reduced-risk products while maintaining its dominant position in the tobacco industry. Here's why I love this stock, and at the end you'll get the biggest red flag. First is Dividend King status delivers royalty-level consistency. Altria has been hiking its dividend for over 55 years straight, earning it Dividend King status, and with a current yield around 7 to 8%, it's a cash flow machine for income investors. In 2025, expect another modest bump, as the company's targeting a steady 80% payout ratio backed by solid earnings. Second is pricing power keeps the cash rolling in. Even with cigarette volumes dropping, Altria's ability to raise prices on its addictive, iconic brands like Marlboro keeps profits humming along. Analysts see earnings growing about 3.5% annually through 2025, ensuring that juicy dividend stays well-funded. Third is smoke-free future fuels' long-term potential. Altria is not just resting on cigarettes, it's investing in smoke-free products like Enjoy vapes and On nicotine pouches, which saw huge volume jumps in 2024. This shift could spark new growth in 2025, giving investors a safety net as the tobacco landscape evolves. The big red flag is cigarette decline could stub out the party. Cigarette sales keep sliding, down over 10% in 2024, and if Altria's smoke-free bets don't pay off fast enough, that high yield could start looking shaky. The company's walked back some ambitious 2028 goals already, so diversification's a must-watch in 2025. Coming in at number 4, we have EPR Properties, and the ticker is EPR. EPR Properties is a real estate investment trust that specializes in experiential properties, including movie theaters, amusement parks, ski resorts, casinos, and other entertainment venues. Headquartered in Kansas City, Missouri, the company focuses on owning and leasing properties that provide unique leisure and recreation experiences. Here's what to like and one big red flag about EPR Properties. First is sky-high yield that pays the bills. EPR Properties is serving up a mouthwatering 7.1% dividend yield as of early 2025, paid monthly, which is like a steady paycheck for income-hungry investors. With over 650 consecutive monthly payments under its belt, this REIT's consistency makes it a dream for anyone looking to stack passive income in 2025. Second is, experiential growth is the new box office hit. EPR's shift from movie theaters to experiential properties like amusement parks and ski resorts is paying off, with tenants like Six Flags and Vail Resorts driving steady rental income. This diversification means it's not just relying on popcorn sales anymore. It's building a stronger, more resilient portfolio for the future. Third is interest rate tailwinds are ready to pop. With interest rates expected to ease in 2025, EPR's valuation could get a serious boost, making borrowing cheaper and acquisitions more tempting. A rising stock price plus that fat dividend could spell double-digit total returns for savvy investors this year. And the big red flag is debt could spoil the party. EPR's got a hefty $2.9 billion debt pile on its balance sheet, and if consumer spending tanks or tenants struggle, that leverage could squeeze its cash flow. While the dividend looks safe now, any economic hiccups in 2025 might make this high yield feel more like high risk. Coming at number 3, we have Regency Centers Corporation, ticker REG. Regency Centers Corporation is a real estate investment trust specializing in open-air shopping centers primarily anchored by grocery stores. Headquartered in Jacksonville, Florida, the company owns and operates a portfolio of retail properties across the United States, focusing on locations with strong demographics and high foot traffic. Here's what I like about this stock and the main red flag to look out for. First is dividend growth that keeps on giving. Regency Centers just bumped its quarterly dividend by 5.2% to just over 7 cents per share for 2025, marking its 11th straight year of increases. That's a solid signal of confidence from management, backed by strong cash flow from its high-quality properties, making it a reliable pick for income investors like us. Second is grocery-anchored stability in a shaky world. With a portfolio packed with thriving shopping centers tied to rock-solid tenants like Kroger and Publix, Regency's focus on suburban areas with strong demographics means steady rental income. Even if the economy wobbles, people still need groceries, and that's a built-in buffer for consistent dividends. Third is record-breaking leasing power. Regency crushed it in 2024 with record leasing activity and high occupancy rates, setting the stage for revenue and net operating income growth in 2025. More leases at higher rents equals more cash to fuel those juicy dividend payouts. Music to our ears. The main red flag is high price, high risk. Regency's stock isn't cheap, trading at a premium compared to some other retail REITs, which could mean limited upside if interest rates spike or the market cools off. If valuations get stretched too far, that juicy dividend yield might not feel as safe as it looks. Coming in at number 2, we have Getty Realty, and the ticker is GTY. Getty Realty is a real estate investment trust that specializes in freestanding gas stations, convenience stores, and automotive service centers across the United States. Headquartered in New York City, the company focuses on leasing properties to national and regional operators in the retail fuel and convenience sector. Here's why I love this stock and the big red flag. First is rock-solid dividend growth that keeps on giving. Getty Realty has raised its dividend for 11 straight years, with a recent 4.4% bump to 47 cents per share quarterly, showing they're committed to putting cash in your pocket. With a juicy yield around 6%, this consistency makes it a no-brainer for income hunters like us in 2025. Second is recession-proof properties fueling steady cash flow. Their portfolio of over 1,100 properties, think gas stations, car washes, and convenience stores, is built to weather any storm since people need these essentials no matter the economy. That stability translates to reliable rental income, keeping those dividends flowing smoothly. Third is smart expansion, with a $240 million war chest. Getty's sitting on nearly $240 million in committed capital for 2025, ready to snap up more high-yield properties at an average initial cash yield of over 8%. This aggressive yet calculated growth means more revenue and, you guessed it, bigger dividends down the road. The big red flag is overvaluation could stall your gains. Trading near its 52-week high of $33.84, some analysts are whispering that Getty might be a tad overpriced based on fair value estimates. If the market cools or interest rates spike, that premium could shrink, so keep an eye on the entry point to maximize your returns. Coming in at number 1, we have Energy Transfer, ticker ET. Energy Transfer LP is a midstream energy company that owns and operates a diverse portfolio of oil and natural gas pipelines, storage facilities, and processing plants across the United States. Headquartered in Dallas, Texas, the company transports and stores crude oil, natural gas liquids, and refined products. Here's why I love this stock and its big red flag. First is monster yield that pays the bills. Energy Transfer's rocking a juicy dividend yield of around 6.5% right now, way above the S&P 500's measly 1.4%. That means for every grand you invest, you're pocketing about $65 a year in passive income. Perfect for anyone looking to stack cash flow in 2025. Second is growth engine keeps humming. This company's not just sitting pretty, it's growing, with a 13% jump in adjusted earnings, before interest, taxes, depreciation, and amortization last year, and a projected 5% bump in 2025, fueled by smart acquisitions like WTG midstream and organic projects. More cash flow means more fuel to keep that dividend train rolling and even bump it up 3 to 5% annually. Third is rock solid cash flow fortress. Energy Transfer's got a stable backbone with long-term fee-based contracts powering its massive 125,000-mile pipeline network across 44 states. That steady cash flow covers the dividend with room to spare. Over 50% of its distributable cash flow stays in the bank for growth or rainy days. The main red flag is MLP tax maze could trip you up. Energy Transfer is a master limited partnership, which means tax-deferred distributions. Sweet. But also complicated K-1 forms and potential headaches if you're holding it in a retirement account. It's not a deal breaker, but if you hate tax season or love your IRA, this could cramp your style. And also, don't forget to click the link in the description to get Seeking Alpha Premium so you can attend their dividend investing forum. I personally love these forums, and other stock forums I've attended have given me good stocks to invest in.